If you're clicking on this video, there's a good chance you fall into one of two different categories. Number one, you've been sold some type of universal life insurance policy in the past and you're looking into it and you want to make sure it's set up correctly. Or number two, you're being pitched universal life insurance right now and you're wondering, is this a good idea and is this where I should put my money? And in this video, I'm going to explain exactly what universal life insurance is, who it's right for, and one of some of the biggest problems that I have with this product. What is up, guys? For those of you new to the channel, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price. So if that sounds interesting to you, I'll put a link in the description and you can check it out below. But without further ado, let's get right into the video. So before I get into universal life insurance, I'm just going to go over the few different types of life insurance out there, just so you kind of have an idea, so we have some base ground that we're starting from. So there's three different major types here in Canada. We have term life insurance, we have whole life insurance, and we have universal life insurance. So term life insurance is the easiest to understand. It just covers you for a very specific period of time. You pick a set term, whether that's 10, 20, or 30 years. You pay the premiums during those years. You can renew it or convert it in most cases if you wanted to. So renewal is very simple. If you had it for 20 years, it would renew for an additional 20 years. Of course, the price is going to go up as well. But in most cases with term life insurance, we're just looking to cover ourselves for a specific period of time. So it's easily equatable to, renting your house, for example. It's just like auto insurance. If you have a car, you insure it. If you sell the car, you don't have insurance anymore. With term life insurance, we have children, we got married, we have a house, we have financial responsibilities. If we were to pass away, our loved ones would be financially impacted, but hopefully we're going to get to the age where we no longer need this. So maybe now we're in our 50s or 60s, our kids are out of the house, we have our mortgage paid down, we have some investments and some accumulated savings that are built up over the past, 20 or 30 years. And if we passed away, of course, there would be an emotional impact, but the financial impact wouldn't be as severe. So hopefully we can cancel that. And that's the idea with term life insurance. Now with permanent life insurance, that's the idea of, hey, I want to have coverage all the way to the end, no matter what. And in Canada here, we have two different types. We have whole life insurance and universal life insurance. Whole life insurance is the easiest permanent life insurance to understand. In my opinion, it's the safest, but it is a little bit more expensive compared to universal life. But I'm going to get into exactly why that might not be a good thing for universal life insurance. So whole life insurance is very simple. You pick a payment period. Maybe that's a 10 pay or a 20 pay. You can do a life pay as well, depending on what your goals are and circumstances for the permanent is. But the idea is it's like a mortgage now. It's going to be roughly 20 to 25 times more expensive than term life insurance. So if term life insurance is $100 a month, this is going to be $2,000 to $2,500 a month for the exact same amount of coverage. But the idea is that you're putting a lot into it up front. You're going to pay it off. Let's say you pick a 20 pay. After the 20 years, it's done being paid for. You have the coverage for life, but you no longer need to pay for it. With whole life insurance, there also is that cash surrender value. So that's that equity within the policy that you can access via a number of different ways. And I'm not going to get into it right now, but you can access that. And it's kind of like the equity within your insurance policy, just like the equity within your home. If you paid off your home, you have some equity within that. Now, universal life insurance, on the other hand, is a little bit more complicated and a little bit different. So let me explain the basics of how universal life insurance works. So basically with universal life insurance, we have two different components, and these components are what they call unbundled, meaning that you can fluctuate this one and you can fluctuate this one, and you can kind of make it really flexible and you can adjust them as per your needs. So the first one we have over here is the cost of insurance. And the second one we have over here is your investment or your fund account, okay? So let's first talk about the cost of insurance. With universal life insurance, there's two different types of cost of insurance that you can pick. The first one is what's known as YRT, or yearly renewable term. And now what this means is that in any given year, whatever year it is, you're gonna have the price of insurance based upon that 1 year. So if you buy the policy when you're 30 years old, the cost of insurance is gonna be based on a 30-year-old male, assuming that you're a 30-year-old male, it's gonna be based on your health at that year. Now, in the 31st year, or your 31st year, that price is going to increase, and then 32, 33, 34, et cetera, et cetera. So the price is based on each individual year, and it's going to increase as you get older until you die. The price is going to get more and more expensive up until, age 100 or you pass away. Now, the other type of cost of insurance that you can pick is what's known as level cost. So instead of being based upon the specific year you're in, now this is just going to be a fixed cost until you die. So if you buy that at age 30, it's going to be priced as if you were going to have this coverage till age 100. Now, the other component that you have over here is this investment account. Like I mentioned, they're unbundled and you can fluctuate them as per your needs. Now, the investment account works very similarly to any other type of investment account. You can basically mimic the funds of any underlying fund on the market. So you can have fixed income, you can have equities, you can put it in the S&P 500. You can put it into some different stocks, some different bonds, GICs, etc., etc. Now, the idea behind a universal life insurance policy is whatever cost you pick for your cost of insurance, the idea is that with this investment account, you're going to eventually be able to have so much returns that all your returns within the investment account will pay for the cost of insurance. So the entire principle is that this is a very flexible, unbundled account, and you can see what you're earning in your investment account, and then you can use those returns to pay for the cost of insurance over here. Now, the benefits of a universal life insurance policy is that, again, it is very flexible. You can, adjust these as you need. It's also very transparent. You can see exactly what's going on. You can see over this investment account, you're making 5% per year or 10% per year. And now you can start to look, okay, I understand that this is going up. I understand if I look at the illustration, this needs to make 8% per year for the next 30 years. And then at that point, that will pay for the cost of insurance. And you can also fluctuate your cost of insurance as well. You can start out with your yearly renewable term, and then lock it in later on in life to a level cost if that's something that would work for you. But you can obviously see that this is a bit of a complicated product, and it's going to require some management on both your part and the advisor's part to make sure that A, your investment account is making enough money within that account to eventually pay for the cost of insurance, and B, that you're also watching the cost of insurance. Maybe you started out with a YRT and you want to lock in a level cost later on in life because it's going to get very, very expensive later on, and you're not going to be able to pay for it with your returns. Now, another thing with the investment account is it's just like any other investment account, whereas absolutely you can get plus 5%, plus 10%, but also you can get negatives as well. You can lose money within your investment account. So this is one of the biggest drawbacks of a universal life insurance policy over a whole life. There's a potential for a higher upside. You may get a cheaper product with permanent life insurance. However, there's also a higher potential that it might collapse, it might not work out, and you might lose the policy altogether. So you pay for this flexibility and this potential upside with a potential downside. Whereas whole life insurance, on the other hand, is relatively guaranteed. You're paying for a specific amount of years, but after that amount of years is done, the policy is paid off. You don't need to worry about it. It's not going to collapse. It's just going to be there for the rest of your life. So here's the thing though. I've been in the insurance industry for almost 10 years, give or take now. And the problem with universal life insurance isn't necessarily the product. I've actually made other videos where I talk about where universal life insurance could be a really good product. The problem that I have with universal life insurance is who is selling this product. And what I find is that most MLMs are pushing universal life insurance, not only for their advisors to sell, but they're pushing it as this quote unquote investment. So, oh, hey, instead of investing in your RSP or your TFSA, you should buy a universal life insurance policy because it's tax deferred and you'll get life insurance and yada, yada, yada. And there's a lot of problems in this. And later in this video, I'm going to go through an FSRA document where they talk about the problems of universal life insurance. But the real problems that I have with it is a couple different ones here. So the first big problem that I have with this product being sold by MLMs is, unfortunately, whether you like it or not, most people that get into an MLM are going to fail and they're going to quit. So what you have is you have advisors that are relatively new to the industry. They have half a year or a year experience, and they go out and start selling an incredibly complicated product that they don't even really understand. And then also, because of the high probability of them getting out of the industry and failing in this is so high, like I mentioned, they're probably not going to be there to help you service this type of product, to help you look at the returns later on down the years, to make sure that it's still on track, and to make sure that if you did need to switch the cost of insurance, that would be done. Number two big problem that I have with this product is the illustrations. This really frustrates me, is with advisors, they can run illustrations of this product and they can run any numbers that they want. So they can put in, 3%, 4%, which would be a conservative number, but they don't. They put 7%, 8%, 9% in the illustrations, and they say, hey, look how good this is going to do. Look at all these numbers. Look how much money you'll have at the end of the day. But in reality, that's probably not going to happen. It's probably not going to get 9% on average per year, net all the fees and extra things that are associated with it. It might get 3% or 4%. So you think putting in $200 a month is going to work out, but probably in the long run, it's not going to work out, and you're going to lose a lot of money into this policy, and it's probably going to collapse if you don't put more money into it. And the third biggest problem I have with this sale of universal life insurance is most advisors, especially in the MLMs, are not selling it as a permanent type of life insurance. They're not saying, hey, maybe you need some estate planning later on down the road. Maybe we're looking at some taxes later on down the road. Maybe you have a disabled child and you're going to need to take care of them for the rest of your life, so we should get permanent life insurance. They're not selling it like that. They're selling it as an investment. They're saying, hey, buy this instead of a TFSA or an RSP. Buy this as an investment for the later years. Now, the problem with this, and I've made many other videos about this subject, but the problem with this, using life insurance as an investment, especially using universal life insurance as an investment, is incredibly complicated. I've made many other videos on the channel where I talk about using life insurance as an investment and comparing it to a standard RRSP and TFSA. And by the way, those registered accounts will always win. Always invest in that first. The problem with universal life insurance is it's even more complicated using this investment strategy, quote unquote. The loan requirements on universal life insurance are way more complicated than whole life insurance. So what I find is that most advisors selling this as an investment are doing a huge disservice to their clients, and they're forgetting all of those other important accounts such as an RSP or a TFSA. Now in 2023, the FSRA, which is a regulatory body in Ontario that governs insurance, did an investigation into 3 different MLMs: Experior Financial, Greatway Financial, and World Financial Group. Now I've made other videos on the channel talking specifically about what happened with that investigation and what fines were levied and what they were doing, etc. That was uncovered in this investigation, pardon me. However, today I just want to focus on a document that the FSRA released talking specifically about universal life insurance. And they made this document after they released the investigations and the findings from these 3 different companies, because they found that these 3 companies were the biggest sellers of this product, and they found how unsuitable it was for many clients. And by the way, if you're looking for this document, I'll post a link in the description and you can download this document. And I just want to read a few things off this document. One of the things that I want to stress is, with a lot of brokers, you can watch this video that I'm putting out, you can watch another video from another guy, you can listen to some presentation at one of these places, and it's hard to try and figure out who is telling the truth. Who knows, who has this secret, they love to talk about it like it's a secret. Who has this secret golden egg that they don't want you to know about, and who's lying, etc. And what I want to illustrate about this document is, this isn't my opinion. This is the regulatory body in Ontario that governs insurance. So this isn't my opinion. This is the government coming in and saying, hey, wait a second, there's financial harm being done, and here's our opinion on the matter. So I'm just going to read here. This is the Universal Life Insurance Overview from the FSRA. Not my opinion. This is a regulatory body of insurance in Ontario, and this is their opinion of it. It says, UL is a unique, relatively complex product. It combines a tax-free, flexible, self-directed investment component, like I mentioned, and a flexible permanent insurance component into a single product. The types and amounts of both, which can be adjusted based on the client's needs and change in circumstances. Further, Canadian tax law allows policyholders to overfund their policies by paying higher premiums than required into the investment component of the policy on a tax-free basis. The resultant accumulated cash value can be used to fund the cost of insurance and policy fees, or as collateral to borrow against in the future, which I kind of mentioned about that investment component, and/or it can ultimately be paid out to the beneficiaries tax-free. These unique features are what set UL apart from other life insurance products, and while a major feature of UL lies in its flexibility and in the ability to overfund the premiums, this unique feature is also what makes UL a potentially risky product if sold and/or utilized inappropriately. In addition, the introduction of TFSA's tax-free savings accounts in 2009, coupled with changes to the tax rules in 2017, that was tax rules for a universal life insurance policy, that significantly limit the amount that can be invested tax-free within permanent insurance policies. This has reduced the attractiveness of UL for most Canadians. In fact, FSRA's conversations with multiple insurance companies in 2023 confirmed that for the various reasons listed above, UL insurance is generally sold as a niche product for the vast majority of their customers. Further, many UL policies may be sold under the guise of creating an IRP, or insured retirement strategy. Again, this is the invest in life insurance strategy that a lot of these MLMs will push, where the policyholder borrows against the cash value of the policy to supplement their retirement income. While these plans or strategies can be effective for the savvy consumer, they require even greater analysis, before being implemented and carry, significant additional inherent risks. Finally, even in situations that may seem ideal for UL, the complexity of such products can make them confusing, difficult to understand, and at risk of undermining the reason most Canadians buy and need life insurance in the first place, to provide peace of mind and financial security for surviving dependents in the eventuality of one's death. In summary, while there are always exceptions, there is a wide-ranging consensus that UL is generally most appropriate for clients who have a genuine need or purpose for permanent life insurance, are already maximizing other tax advantage accounts such as TFSAs and or RRSPs or Registered Education Savings Plan, or ESPs as applicable if you have children, and who do not need access to their overfunded premiums in the short to medium term. C, they are prepared to carefully monitor and adjust their policy on an ongoing basis. And D, they have sufficient means to support increased premiums in the case of future poor investment performance or volatility. Now, in light of these factors, it is also accepted that for a UL strategy to work, number one, the agent selling the product must be ethical and thoroughly knowledgeable about UL and all its components and able to customize the product to fit the customer's overall financial picture, risk tolerance, and overall financial plan, which, and I don't mean to shit talk here, but most advisors that have been in the industry for 1 to 3 years with one of these MLMs is not going to be that type of agent. Number two, the customer must be savvy, understand their policy options and the inherent pros, cons, risk, and benefits of each. And number three, the policy must be the policy must be regularly monitored by the agent and or customer to ensure it continues to meet its intended purpose and that it is adjusted in a timely manner as appropriate to avoid policy lapse. Without these fundamental pieces, the effects would be catastrophic, resulting in policy lapse and a corresponding loss of all premiums paid into the plan, including overfunded amounts. Now, I'm not going to get into the entire rest of the document. Again, I mentioned that I did put it in the description below, but if you want to read that, obviously go and check it out. The rest of the document is actually very good. It still talks a lot about the dealings that they've had with these MLMs and what they've uncovered in their investigation, specifically where they found that in most cases, they didn't have a real proper needs analysis for the client. The clients didn't have other registered accounts maxed out or even used in the first place, such as TFSA or RSP. And in a lot of cases, they actually found that the customers had outstanding debt that they hadn't paid off, which again, I mean, if you're losing so much, in debt, let's say your interest rate is 10% or 15% in debt, then anything you don't put towards that debt, you're losing 15%. So you can see in a lot of these cases, in most of the cases actually they found, it didn't make sense for the client to have that. So in summary, universal life insurance isn't necessarily a bad product. However, it's not suitable for the majority of Canadians. There's a very few specific circumstances in which this may be a good product, but as you can see, there are very few and far between. And for the vast majority of Canadians, this is probably not the best product for you. So with all that being said, I hope that you guys enjoyed today's video. If you guys have any questions or comment, put it down below. And as always, if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.